Oh, thank you very much. Secretariat of the ALI, they're doing an excellent job these days. Good morning to all the participants and welcome to this panel devoted to the project on corporate sustainability and financial accounting and share capital. My name is Corrado Malberti and I will chair this panel. The project on corporate sustainability, financial accounting, and share capital started within the special interest group on business and financial law of the European Law Institute a couple of years ago. And at the beginning of this year, we received the approval from the Council of the Institute to proceed with a fully fledged project. The project we will discuss today is still at an early stage, so any input obviously from the speakers, but also from the attendees will be really welcome. To discuss this project today, we have 4 distinguished panelists. We have Yuri Biondi and Colin Aslam, that are both reporters for the project. Professor Aslam is a professor of accounting and finance at Queen Mary University of London in the UK. While Yuri Biondi is a tenured senior research fellow at the CERN-RS, the National Center for Scientific Research in Paris, in France. They will essentially present the project in the order I will say to you in a couple of minutes. We will receive a comment from 2 project advisors. Martina McPherson, Ms. Martina McPherson. She's the head of the ESG strategy and an executive member at ODDO BHF Asset Management and Private. She's also president of the Network of Sustainable Financial Markets, a think tank devoted to sustainable finance. Professor Hideki Kanda, who is an emeritus professor at University of Tokyo and a professor at the Gokushin University Law School in Japan. The order of the intervention we agreed with the speaker is to give first the floor to Yuri Biondi to present the project, then to Professor Kanda, followed by Martina McPherson, and then Professor Aslam will react to the comments received, and it will also give us his impression and state of development of the project. I would like to remind to you that the questions and comments are welcome. In the chat you have a function at the bottom that is named the Q&A, and you can send your questions, your remarks using that tool, and we will react at the end of the panel, since we will have around 15 minutes devoted to the I would like finally just to remind to you that we will have only 75 minutes, so I do not take more time, and I give the floor to Yuri Biondi to present the project. Thank you very much.
Thank you very much, Corrado. Thank you very much to all the participants who have kindly accepted to be here with us this morning. Thanks for the public to be there. So I will share my screen to give you the opportunity to follow my slide. Just a minute. So, okay. So as Corrado has already explained, we started the project 2 years ago in the context of the special interest group of, on business and financial law at the European Law Institute. And this also was based upon the green paper we published as a sort of background paper for our SIG work in 2017. And since last February, the project is now endorsed by the European Law Institute, has become an official project of the Institute. So my speech provide you some basic information and background about the project. Aim, of course, the expected outcomes, the team, the research and advisory teams, and some preliminary finding and preliminary assessment of policy option for the European Union on these matters. Of course, we cannot provide the final finding and recommendation, but since we have already worked for 2 years, we essentially virtually close the review phase, and we can so share the first preliminary finding of this initial phase of the project. So the project was started in the context of a huge and important debate on how companies do and should respond to environmental and social consideration. This is a hot topic today, both at the policy agenda, but also for the general public, for the investor community, and for society at large. And our special contribution, so what we want to add to this ongoing debate is to focus on the relationship between corporate sustainability, company law, and financial accounting. Our basic assumption, which is common sense assumption to our viewpoint, is that only financially robust companies can respond properly and timely and effectively to environmental, social, and governance considerations. And only financially robust companies can assure investor and creditor protection, including when these environmental, social, and governance considerations are into consideration. So company law requirements are fundamental to assure company sustainability through time and circumstances, because these company law requirements are there to assure both the investment creditor protection and also the capacity of the company to respond to these ESG concerns. And from our viewpoint, financial accounting or financial reporting, they are synonymous in our context, provide a convenient legal economic instrument to control for share capital management. And this is a common background for both the regulatory purpose and the private governance purpose, or the management purpose as well. So essentially, from our viewpoint, and this is a sort of value added by our project, we will use financial accounting measures and financial accounting standards as a common background to both regulatory intentions, corporate governance needs, and managerial concerns, in view to achieve better environmental and social management. We expect to generate as a project two main outcomes: a position paper, a policy paper, as we call it, which will review and analyze the context of our work and our proposal. So it will provide the background or our view on these matters, and a set of more specific recommendations summarizing a statement of principle, which are being to be hopefully impactful on the overall policy debate. So our recommendation will try to contribute to the regulatory and legislative work at the European Union level, but also at the member state level concerning company law, as far as prudential capital management and distributions to shareholders are concerned. So we also generate the first academic outcome because the panel of the last year was kindly published by the European Company Law Review, one of the 3 leading journals in company law in Europe. So this symposium, Company Law, Prudent Management, and Corporate Sustainability, is now published by the journal. Kluwer is the publisher. You can find our initial thought, which were the inputs for our review phase, which has now finished. The team members, we have two boards. One is the research team, which has been designed to be international and interdisciplinary with a common interest in EU law and regulations. The three reporters are all here this morning. So myself, Corrado, who chairs the panel, and Colin. So we lead the development of the project and also the preparation of the statement of principle and the policy paper, along, of course, with the research team members, because this is a collective endeavor. And the advisory committee and two esteemed members of it are here with us this morning, Martina McPherson and Professor Hideki Kanda. We try to invite them in order to balance the presence of academic and non-academic members. And so beyond academics, you also have representative or members of the Council of Bar and Law Societies of Europe, Financial Reporting Council, the European Commission Informal Expert Group on Company Law and Corporate Governance, the French Accounting Authority, the Italy Supreme Court, the Club of Rome, and KPMG, leading international auditing and consultancy firm. So in our first phase, when we review the evidence, the existing evidence to draw upon to develop our recommendation, we prepared several reports during 2 years of work, especially three kinds of reports. One was a report on empirical evidence of corporate practice in social and environmental matters. And corporate sustainability. One, a review of the EU legal framework concerning sustainability, and three country reports, one on Germany, one on Italy, and one on Japan. And these country reports focus on the specific measures on financial accounting and the share capital management. And Japan is especially important for us because it provides an illustrative example and also a benchmark, because Japan has already developed accounting standards and also company law requirements. We are quite akin with the spirit of our project and this connection between the financial accounting regulation and the prudential management of companies. Concerning our the empirical evidence we collected on corporate behavior, our evidence, we started before in 2019, but at the end, our evidence is in line with the inception impact assessment prepared on behalf of the European Commission and published in July 2020 on sustainable corporate governance and accompanying studies. In both our report and that impact assessment, many companies were found, especially the listed companies on regulated exchange in EU, were found to face pressure in order to generate a financial return in a short time frame, the so-called short-term issue. And those companies also were found to distribute a large part of their income to shareholder investors. That's that prioritizing shareholder investor needs over other stakeholders and general social and environmental concerns. So the risk here is that excess distribution to shareholder investors may be a detriment of the long-term development of the company, reducing the research and development investment, for instance, the reducing interest in resources for innovation, including that required for social and environmental response. And also excess distribution can therefore undermine corporate sustainability over time and the capacity of a company to respond to possible or eventual crises. So the second review we prepared concerned law and regulation on corporate sustainability. So we summarize this, that the idea of sustainable development is very present in the EU regulatory framework and is based upon three pivotal backbones. So the first is the company as a going concern. So the company is expected to go on indefinitely and to be able to self-sustain over time. So it is a basic assumption for management, governance, and regulation. And a second purpose of the regulatory framework in Europe is the high level of protection of employees and creditor rights, and the two go along together, and they are not alternative or competitive interests, but both has to be protected at the same time by the corporate behavior. And the third, but not the last, is the need to promote sustainable investment, including environmental investments and commitments which are required to meet the green transition, the green economy transition. The problem is that notwithstanding these backbones, this fundamental principle which exists are endorsed by the EU regulation, the current capital maintenance regime doesn't refer to long-term sustainability. So long-term sustainability is not yet explicitly considered by the equity regulation for companies, for EU company law. And in addition, the regulatory competition between the member states could be problematic because the Grand Acquis by the European Court of Justice said that the least constraining member state regulation has priority in case of transnational dispute. So it doesn't mean that company law no longer exists, but it means that even just one member state weakened the requirement, that member state can get a competitive advantage over another member state which put a stricter regulation in place. And also another neglected but very important element and limits of the existing regulatory framework in Europe is its dependence on international accounting standards. When the company law framework was established, the standards were internally developed by the European Union through the two directives. But nowadays, a legislative delegation was provided to the ISB, the International Accounting Standard Board, which is a private body established in London. And this international accounting standard introduce current value measurement, the so-called fair value accounting, which has imminent problem, which raise imminent issues, important issue for corporate sustainability. So our analysis led us to identify the several policy inconsistencies in the current setting for corporate sustainability purpose in Europe. So we have a first inconsistency with the received approach to corporate governance, which focus on shareholder right and shareholder value orientation, while neglecting other stakeholders, the environment and society at large. But also with the received approach to freedom of establishment, which neglect undue pressure on corporate sustainability due to regulatory competition and the opportunistic use of corporate groups, including transnational entities and transnational transactions. And the last but not least problem is this inconsistency with the Grand Acquis by the European Court of Justice case law, which neglect the most recent dependency on accounting standard, as well as new types of distribution, such as share buyback and reserve distribution. So the focus is on limiting distribution of dividends in the more straightforward and more classic way, let's say received way. But new kind of distribution exists nowadays, which are very important in financial market in particular, and they should be carefully considered when corporate sustainability purpose is under target. So what we have identified is that a need, because of this policy inconsistency, for an harmonization at the EU level to avoid the regulatory competition and the race to the bottom. concerning social responsibility and corporate sustainability, which is the main ingredient and component of this corporate social responsibility. But also the establishment of the level playing field for both investor and other interests in the company, which may move and should move beyond the shareholder value model and primacy in corporate governance and corporate management. It doesn't mean that we don't want to protect investor interest, but it means that that protection has to go along and be accommodated with the protection of other interests, including social and environmental concerns. So we have identified the two policy options on which we have been working. The first one is in line with the European Commission plans on sustainable corporate governance, so enhancing the duty of director, but also, and this is our specific idea and contribution, better rules on equity capital management. So how company law requirements can help fostering and reinforcing corporate sustainability, and also helping facilitating managers to better provide for corporate sustainability. The second is financial accounting, so better reporting on sustainability-related liabilities and commitment, not only in extra financial reporting, but also in the core of financial accounting and financial reporting, because as we have explained it before, only financially robust companies can afford and pay for social and environmental commitments. And so we really need to better report on the financial dimension of these considerations, and also help manager to have tools, internal tools, to convince both the company and the directors and the investors to go in that direction. So, of course, this go along with a better reporting on distributions and retained earnings, which has to balance between distribution to external parties and the internal resources which are kept by the manager to develop social and environmental projects. Okay, so thank you very much. This is what I can say safely according to what we have developed in the last 2 years, and we have already prepared, and we look forward to your comments and suggestions. Thank you very much.
Very much, Yuri. As Yuri was saying, the Japanese experience is a source of inspiration for our discussions. And so it is a real pleasure for us to have with us Professor Kanda, to whom I now give
thank you very much, Professor Malberti, and good morning. It's my great pleasure to be here, and it's really my great honor to be here as well. And I think that it's focusing on the relationship between the company law and accounting is very important, but has not been researched or examined in the past years, and therefore the value of this project is quite high. And I'm very much looking forward to the completion of this project. And I'd like to speak about 3 matters. One is capital maintenance rule in company law, and 2 is the mandatory disclosure rule, and 3 is some situations in Japan. And so first about the capital maintenance rule. So generally speaking, as far as I know, in all major jurisdictions, company law requires or provides a capital maintenance rule. And this capital maintenance rule regulates the maximum amount within which a company may make dividends, share buybacks, or other distributions to the company's shareholders. But this capital maintenance rule looks at the number on the company's balance sheet on the liability side. Usually the maximum amount is the amount of net worth minus the amount of legal capital. The reason for this capital maintenance rule provided by company law is, as is very well known, the general creditor protection. So if shareholders, and in particular activist shareholders, ask the company for cash distributions, then such distributions, I have to apologize, there's a typo there, but such distributions are permitted within the limit set by corporate law. That is the within the limit set by the capital maintenance rule. So this suggests that if this company law rule is tight, then the company would not be permitted to accept the shareholders' request to make a large amount of distributions. And which also means that the company may use the company's assets for other purposes, including ESG or other sustainability activities. So the capital maintenance rule may matter depending on the situation. My second point, well, mandatory disclosure rule by laws and regulations. Again, as far as I know, in almost all jurisdictions, there is a huge gap, if I may say so. There is a gap between the reporting of financial information and the reporting of non-financial information. Today, both financial information and non-financial information are important, and therefore laws and regulations require the reporting of these both informations. However, the reporting of financial information required by the legal regime is, of course, made on the premise that the information produced or disclosed must be prepared in accordance with generally accepted accounting principles, plus the information must be audited by certified auditors. In contrast, when you look at non-financial information, this reporting of non-financial information generally lacks this premise. That is to say, the standards are underdeveloped and audit assurance is underdeveloped. As Yuri briefly mentioned, that this International Accounting Standard Board now, aside from that, the international body plans to set up International Sustainability Standard Board, ISSB, in this autumn. And therefore, as far as sustainability or climate change is concerned, lots of standard setters compete right now, and the standards will be developed sometime very soon. But when it comes to other non-financial information, it seems to me that the standards do not exist, so that the companies just disclose their policies or what they are doing on these matters without no standards. And audits or assurance so far has been very underdeveloped. So in other words, I think that the value of disclosure to investors and also other stakeholders is different between the financial information and non-financial information, which means, I guess, that this ideally we should look for the integration of financial and non-financial reporting, perhaps with coordinated standards as well as coordinated audits or assurance. This is very important, not only for the interest of investors, but also for the interest of other stakeholders as well. Now my third point, next slide, please. Thank you very much. I'd like to talk about some situations in Japan. In recent years, the activist shareholders in Japan often, and activist shareholders may exist outside Japan, but often ask Japanese companies they invest in to make a large amount of cash distributions or stock buybacks to their shareholders. And most companies, as far as I know, have the enough amount of retained earnings which satisfies the capital maintenance rule by company law. And therefore, those companies would make large distributions possible. However, of course, there are some exceptions. And so some companies do not have enough retained earnings that satisfy the capital maintenance rule. And then those companies, of course, are not permitted to make a large amount of distributions. But you have to be careful, of course, the capital maintenance rule by corporate law or company law looks at the account numbers in the right half of the company's balance sheet, that is the liability side. And therefore, having enough retained earnings does not necessarily mean that the company has enough assets on the left-hand side or asset size. The company may not have enough cash or other liquid assets for a large amount of distributions to its shareholders. For the Japanese companies, having certain 3,000 to 4,000 large public companies. Next slide, please. Perhaps that is much easier. If you look at the large public company, 3,000 to 4,000, you will see over the past 30 years, the total amount of cash and bank deposits did not change much. It is interesting. On the other hand, the total amount of other assets for the purpose of statistics are very poor. The other assets increased by 50%, and the total number is much larger, 582 trillion yen, which is around 5 trillion euro. And what are these other assets? These other assets generally mean so-called non-performing business assets. And as such, they are usually illiquid assets. This means that in order to make a large amount of distributions, even though if the company meets the capital maintenance rule and has enough retained earnings, but that the company sometimes would have to sell those assets in order to get cash for distributions. However, the important thing is engaging, perhaps one slide back, please. One page back. Thank you very much. However, I think the engaging in ESG activities also has the same problem. And that is to say, to do ESG or sustainability activities, companies need funds. And therefore, they sometimes would have to sell their illiquid assets or otherwise obtain cash. So in summary, I think for most Japanese companies, capital maintenance rule by company law is unimportant in the sense that they have enough retained earnings. But there are exceptions. And for those exceptional companies where the retained earnings are not in a large amount, then the capital maintenance rule does matter. And but anyway, in some companies, I wouldn't say most companies, but some companies face the funding program if they attempt to make distributions to the shareholders, but the same is true if they attempt to do ESG activities. So those companies do not have enough liquid assets on the asset side, and therefore you have to sell some business units or non-performing business assets. Capital maintenance rule, therefore, may and may not be relevant depending on the situation. And also, as I said, disclosure regime is different between financial information and non-financial information. Therefore, these matters seem to be a very interesting topic for future research. And as I say at the outset, the relationship between company law and accounting has been much neglected, I think, in the past research. And this project takes a look at this important relationship between company law and accounting. And I very much look forward to the completion of this project and then also the final policy recommendations to be made by this project. Thank you very much.
Thank you very much, Professor Kanda, for the full presentation. I now give the floor to Ms. McPherson, who I guess will focus on.
Thank you very much. Very nice to meet you. My name is Martina McPherson. As outlined, I have multiple hats in industry, academia, and I'm also chairing a worldwide think tank / NGO on sustainable finance. And I'm here to quickly present to you the developments that we are seeing from an industry perspective in the context of when and where the EU Sustainable Finance Action Plan and various normative developments are now hopefully driving towards harmonization of standard metrics and assessment frameworks, which in turn will enable us as industry participants to build rules-based approaches for and in line with sustainable finance and sustainable investing. Maybe if we share the first slide, please. The next one, thank you. Ultimately, what has been happening in markets over the last 5 years is that environmental, social, and corporate governance investment strategies have very much reached the mainstream and have never been more popular. We are now talking, when we look at assets under management, funds incorporating ESG, whether for risk management, compliance, sustainable and/or investment initiatives, that these are now totaling more than $40 trillion according to OPIMAS in 2020. This is up from around the number of $12 trillion in 2012. And with the risk and return opportunities in ESG investing, there's also a shift in investor preferences. When we look, for instance, at the availability of new products that are increasingly driving more and more investors towards considering sustainable or ESG approaches, such as screening, integration, engagement, and ultimately this is leading their investment decision-making processes. Side by side with this, what we classify as market momentum, we have of course also been seeing a broad array of normative and now increasingly regulatory frameworks that are shaping the debate for investors in the ESG domain. And I'm sharing here quite deliberately some of these more initially normative developments towards regulatory developments on the slide that you can see here, also to showcase that ESG, even though it's been very much becoming a hype, is not something new. It is in existence at least maybe even before clearly 1997 with the Brundtland report in the 1980s, which looked at already implications for sustainable development. But clearly since the late 90s and early 2000s, we have seen multiple frameworks for climate and sustainability risks that are shaping the debate for today. Up and foremost to mention here, of course, the Kyoto Protocol, the UN Global Compact, the principles for responsible investment, which are now ultimately the principles and the standard for the industry, and then another normative framework of very significant importance, the Sustainable Development Goals, and lastly, of course, the Paris Agreement from 2015, which came into force from 2016 onwards. What's been driving now the debate and ultimately the developments in the investor sphere since 2018 and 2019 in particular are the various development streams here at an EU level when we look at the regulatory regime for sustainable finance. On the 7th of March 2018, the European Commission released an action plan for financing sustainable growth. And these were based on the recommendations from a high-level expert group, the so-called age-led group on sustainable finance, which were submitted to the Commission on the 31st of January 2018. And side by side, we have seen that the European Commission has also really shaped its ambitions towards climate neutrality and towards better sustainable growth in regards to the European Green Deal, which was ultimately launched in 2019. And the European Green Deal, side by side with the work of the European Sustainable Finance Action Plan, are really now shaping the further regulatory commitments that various market participants are making and are having to make towards ESG, We will hear much more about the corporate perspective, so I'm not hence highlighting again the work that's been done around EU NFRD, Non-Financial Reporting Directive for corporations, and its now up and coming regulation for corporate sustainability and the Corporate Sustainability Reporting Directive, but I'm focusing very much more on EU SFDR regulation, so-called EU SFDR 2019-28/8. And this is ultimately a regulation designed to drive the sustainability disclosures of financial products within the investment arena. If I may quickly lead over to the next slide. On the next slide, very high level again, just to highlight the ambitions of the EU's Sustainable Finance Action Plan and how this action plan is supported. It ultimately constitutes of 3 pillars. The main ambition is to reorient capital flows towards sustainable investment in order to achieve sustainable inclusive growth. Then secondly, also clearly to manage the financial risks stemming from climate change, resource depletion, and environmental and social degradation and issues, and ultimately to foster more transparency and disclosure, and of course, long-termism in financial and economic activity. And these 3 pillars are reflected, at least the third one, if we look at the next slide, with the introduction of the EU SFDR. And again, the aim of the EU Sustainable Finance Disclosure Regulation, SFDR, is a set of EU rules to actually provide disclosure on the sustainability profile of investment products. It has itself 4 main objectives: to increase the transparency of sustainability risks and generally negative effects, to improve the comparability of financial products while incorporating sustainability in the investment process, to contribute to the realignment of investment flows or sustainable investments, and ultimately to reduce greenwashing. And SFDR forms part of the EU's wider sustainable finance framework, which we've looked in brief just earlier. And it will literally be a broad set of new and enhanced regulations for sustainable finance across the 27 nation bloc. And it aims to create a level playing field across the whole of the EU when and where we are talking about sustainable financial products. There are ultimately 3 major categories when we look at compliance with SFDR regulation. So we talk about classifications alongside Articles 6, 8, and 9, the equivalent of no, light, and dark green. And as you can see on the slide here, there are multiple timelines and ambitions attached to this framework. When we look at, first of all, disclosure, mandatory disclosure, which has already taken place by the 10th of March, of information around products in pre-contractual information, up and foremost prospectuses, websites, and other public information sources. And we are now waiting to ultimately hear more on other aspects when and where principal adverse impact indicators are concerned. And most importantly, of course, when and where the reporting in line with these so-called regulatory technical standards and principal adverse impact indicators is concerned. Timelines have slightly moved. They were initially envisaged to be around January 2022. They have now been set out towards July 2022. And ultimately, alongside these regulatory technical standards, we are envisaging that the entire industry will have to report in a granular fashion and manner alongside maybe up and around 18 environmental and social categories around the type of activities they undertake, and to align them in turn with the various frameworks in place now already in existing and part of regulation, the EU's green taxonomy, and hopefully in future, the EU's social taxonomy. And here is a last point I would quickly like to make, and we can also lead to the next slide to give an overview on Article 6, 8, and 9 in a bit more detail while I'm talking about the remaining challenges. So first of all, there is a pluralism now of normative and regulatory developments across the EU for corporations and investors when and where disclosure and reporting is concerned. I have touched very briefly, light touch on some of the frameworks that are already in existence and widely used for reporting purposes. I've highlighted here especially the regulatory framework SFDR with a brief note towards the EU's taxonomy. At present, and this is an important note, the EU's taxonomy focuses on green categories only. Social categories are in process. The consultation has just been completed. But ultimately, this means when and where investors are encouraged to report, there is already a slight divergence, potentially a discrepancy when and where timelines are concerned. Another major development which might lead to fragmentation and which should be monitored very closely is that national regulation around ESG disclosures is currently taking place, for instance, in France and Germany. And this might mean that we have different layers and expectations from investors when and where disclosures, classifications, and ultimately reporting on ESG is concerned country by country. And lastly, again, touching back on the normative developments, currently European investors very often use labels to also highlight the greenness or sustainability credentials of their funds. The eco label from the European Commission is still in process and potentially very desperately needed in order, again, to provide more alignment and harmonization between the different type of labels, expectations, and requirements that are now by jurisdiction, for instance, F&G in Germany, ESR in France, Lux Flag, and many others, in regards to the expectations of these very label-specific requirements. The ambition should be to conclude to harmonize frameworks and to provide really a long-term trajectory within the European jurisdiction and beyond. And I'm delighted I've been part of many discussions with normative framework and standard setters such as SASB, now the Value Reporting Foundation, with organizations and associations such as the Deutsche Aktieninstitut and its French equivalent AFAP, and ultimately with the European Commission and other counterparties of the International Platform for Sustainable Finance to highlight some of these prevailing challenges in order also to ensure that our future is sustainable, but in the same time is providing the relevant frameworks we need to build capacity and scale within and amongst the investor sphere. Thank you very much.
Thank you very much, Martina. In fact, what you were saying at the end of your presentation is in line with the question we have received, to which we will provide an answer at the Q&A session. And for sure, the whole project will try, obviously, to strike the balance between the needs of investors, the respect of a sustainable environment, and obviously also the need of having a thriving industry in the European Union, but also in the world. And now give the floor to Professor Aslam to react to the input provided by the previous panelists, and also to give us his impression on the development of the project. Colin?
Yes, thank you. So there's a lot going on here, and I'm going to try to bring it to sort of together and incorporate some of the comments made by Hida Kanda and Martina McPherson, which have been very, very useful. So my response is in this set of sort of slides, and I'll try to wrap in some of the observations from the rapporteurs. Okay, the next slide, please. Okay, so the background, I think, to the European development project over many years has been to improve the efficiency of capital markets around capital market harmonization. And that's been a major driving force across the European Union and its institutions. You know, in terms of providing the infrastructure, regulatory and so forth to promote an efficient and cost-effective functioning of capital markets. And as part of that and conjoining that objective, political objective, we have accounting, which is co-opted into that process through the development of international accounting standards. Because the accounting standards are developed in a way to improve capital market efficiency. So the interests of shareholders and investors was enshrined really within the international accounting standards, because this also helped with the broader political project within Europe, which is to improve capital market efficiency. And Yuri observes in his slides that, in a sense, what happens here is that the accounting process installs a sort of shareholder value or capital market actor maximization perspective within the conceptual framework and the accounting standards. Okay, next slide, thanks. So a recent study on directors' duties and sustainable corporate governance issued by the European Parliament noted that the focus really of corporate governance management of resources within companies tends to focus on short-term value maximization rather than the long-term interests of the company. And this is coming at the cost of long-term economic and social sustainability within European companies. The focus here then has shifted. It's shifted from the idea of companies located within a capital market and functioning within a capital market to companies operating as, you know, legal entities in their own right with responsibilities. And so the implications of these reports coming out in terms of the reports on sustainable development as well as corporate governance, which Martina alluded to, I think changes the focus towards the importance really of the company as the unit of analysis and its contribution to economic, environmental and social interests, which is the company is the main actor that will have to deliver these objectives. We can't assume they will happen through capital market movements. For example, we know with the European trading system that hasn't had the impact we thought it might on reducing carbon emissions in Europe. And the more recent Corporate Sustainability Reporting Directive notes that all large companies are publicly accountable for their impact on people and the environment, which opens things up from purely companies as, in a sense, servicing the interests of their investors and shareholders for capital market efficiency to companies within Europe doing something else for a broader group of stakeholders. And I think this is the opportunity within which the ELI project is operating. Okay, the next slide, thanks. So the project, as I see it, really engages with these challenges, this sort of shift away from the European project, political project, was once being about capital market efficiency and harmonization of capital markets towards a broader agenda around sustainability and ESG. And if we then argue that this is the way Europe wants to go, then the ELI project engages with these challenges in terms of this directional shift. First of all, with regards to reviewing the intention of company law and the role and duties of directors. It's important if the company is to survive as a going concern into the future and deliver on its promises with regards to ESG, it needs to be a going concern, and capital maintenance is important here. And I'd probably sort of reinforce Hideke's point about capital maintenance, that we need to look at this in much more detail in terms of how capital maintenance is the reserve within the balance sheet that maintains the company as a going concern if it's hit by buffers from problems in its product market, or if it has to write down asset values under fair value accounting practices. There has to be some buffer to maintain the company as a going concern into the future, because it's into the future that matters vis-a-vis corporate sustainability and our environment. That is, the commitment becomes a long-term endeavor. And with regards to reviewing the conceptual framework, we want to do that because accounting has become the handmaiden of the big political project around capital market efficiency, but accounting can also become the supporter and engager with the new political project around ESG and non-financial reporting. Specifically, here we would wish the conceptual framework to reinstate issues around prudential financial reporting, capital maintenance, because it's those two pillars that will help sustain companies as economically and environmentally sustainable going concerns. So here we have a sort of change in emphasis, which is in the past, the political economy project was around capital efficiency and lowering the cost of capital through financial disclosures and how accounting is brought into that process. Accounting and company law needs to be brought into a new process, new set of political objectives, which are already being formulated and already being disclosed through the European Parliament's auspices and its research, as well as official regulatory publications. Thank you.
Thank you very much, Colin, and many thanks to all the panelists. We have now 18 minutes that we can use for the Q&A session. We have already received 3 questions, but the participants are invited to submit more. I provide an answer for the very first question, which was more technical question regarding the presentations. The entire recording of this panel will be made available after the end of the annual conference. So you will also be able to find there this morning. Then we have 2 questions, one by Medija Povlakic regarding the involvement of representatives of companies in our project. I would like to say to Medija that this is in fact a recurring topic also in our meetings at the council with all these projects regarding sustainability. I remember also for other projects that we had these. I'd like to give to Yuri the floor to provide feedback to this question.
Thank you very much, Corrado. Thank Medija for your questions. The first one is a sort of internal business. It's always challenging to establish an advisory board, and we have to rely on our personal and professional networks and people which wish to commit their time and effort, and also bring trust and reputation through their name to the projects. So what we have found so far is a list of quite impressive academic and non-academic members, which include associations which represent industry and financial interest. So indirectly, we have industry and corporate interests represented. But I don't remember if we have companies. We are open to it. So if even if the participant want to suggest, we can contact them or we can consider them. At the same time, I want to also react to your second part. We really try to insist that we are not trying to oppose shareholding investors, financial investor interests and needs with the other social, environmental, and stakeholder interests and needs. We really try to revitalize and renew and very evergreen to, in our perspective, but at least old-fashioned approach to the company, which was very well established in Europe, but also in Japan and US, where the company is considered, is understood as a going concern, and that going concern exists because that economic organization go on only with the simultaneous joint commitments by all the stakeholders, including the shareholders. And at the same time, it has to meet broader needs and expectations by society at large. That's to respect nature because it's the common earth we have been living in. And so we don't think all these interests are alternative, because otherwise we should prioritize between giving money to investor and rescue the planet where we live, or giving salaries or giving dividends. Of course, you have a balance to find, and this is up to the managers and the board of directors to do so. And we want to provide the best or a better regulatory framework to facilitate and prompt the best practice on these matters. So yes, I invite you to read again our green paper on this conception of the firm as a going concern, which to us provide a very good background, which go beyond this reductive opposition between shareholders and stakeholders, or between financial interests and social and environmental interests. Of course, it is a balance to find, but I don't think it's an holy grail. It's something which is feasible, has been done in the past, and we have to find novel ways to do it and novel ways to facilitate it through the regulatory framework. Thank you.
Thank you, Yui. Maybe before moving to the next question, I'd like to ask Martina if she would like to add something regarding this relationship between, I would say, sustainability movement and the perspective of companies. Do you have some suggestion to give us on what?
Sure. In relation to involving members through bodies and associations in these discussions, Corrado?
Correct.
Very much so. I highlighted briefly that there are already a couple of stakeholder groups in the corporate sphere, for instance, Deutsches Aktieninstitut, DAI, and of course the French equivalent AFEP, which are also very heavily involved in these discussions here, with the European Commissions, with other stakeholder groups and bodies, and through the representation of these associations, this topic around corporate sustainability and the trajectories for the Corporate Sustainability Reporting Directive, a very important element and brickstone in this context of pan-European regulation for sustainability, is very widely discussed, debated, and obviously there are concrete actions and recommendations coming out of these groups. So I'm involved in one of the groups, working with the DAI as well, talking about even now the upcoming social taxonomy and implications for companies and reporting requirements. And I would really provide a suggestion here for every corporate member as well in this group to get engaged with the bodies and associations representing companies looking for specific sustainability advisory committees or working groups when and where information is widely shared, and of course will be channeled back to the various other groups.
Very much, Martina. I think we can now move to the second question regarding the rise of intangible assets. Play a role in our project. I would first give the floor to Colin to provide an answer to this question, and maybe Professor Kanda could also give us the Japanese perspective on this issue. Please, Colin. You're muted.
Sorry, Corrado, could you just repeat the question again? Sorry, I was just typing a response to the chat.
Apologies, I was muted now. But the role of intangibles, the raise of intangibles.
Yeah, I think that Hideki Kanda raised an interesting issue about the changing composition of company balance sheets. These are increasingly including intangible assets rather than tangible assets. And those intangible assets are predominantly goodwill that arises upon acquisition. If one company purchases another, the difference between the market and the book value of the acquisition is absorbed into the acquiring company's balance sheet as goodwill. And that goodwill is accumulated over time and then also tested each year to see if the goodwill needs to be impaired. And that means that the asset, in inverted commas, of goodwill can become an increasing risk to the stability of companies, because if the goodwill needs to be impaired, then it has to be written off against the shareholder equity funds to balance the balance sheet. So the assets are reduced and so are the shareholder funds. And it's that reason why we also think the shareholder funds need to be augmented in advance of an increasing probability that some of these non-performing assets might have to be impaired and the goodwill written down.
Colin, Professor Kanda, would you like to add something?
Yeah, thank you very much. 2 points on this. The situations in Japan right now, I think the first point is that the importance of intangible assets have been very well recognized among the relevant people. And the government has a policy to encourage the importance of intangible assets to be more recognized, and then ask the companies to focus on those intangible assets for future growth and sustainability. The second point is when it comes to legal regime, or including accounting scheme, I don't think intangible assets has been well recognized. The exception is Professor Hassan mentioned that in the M&A context, it's a company purchases another company, then the goodwill is very often recognized, which may reflect intangible assets. But otherwise, the intangible assets are not being on balance sheet, it's mostly off balance sheet, which means that in the context of financial reporting, the intangible assets appear as non-financial information. And so if the goodwill is part of the accounting and accounting numbers and in part of the financial reporting, then there is split between the financial reporting and non-financial reporting. I think we should improve this situation and perhaps put more direct focus on intangible assets or the importance of intangible assets. It may depend on the situation and it may vary from company to company, but I think the importance of intangible assets will increase rather than decrease in the coming years. Thank you.
Thank you very much. We have 6 minutes left and we have 2 questions in the Q&A. One from Ilaria Pretelli. The question is concerning, if I correctly understand it, what are in the end the results of mandating a non-financial disclosure on evidence of the fact that then the behavior of companies will actually change. And maybe I think that to this question, Martina could give us her ideas, or Yuri, I don't know which of you.
Sure, with pleasure. I think it's an important question. You know, what are our long-term vision, ambition, and ultimately actions? Generally, as an industry, we need to move from commitments to actions. A very concrete example, I've highlighted the Paris Agreement, trajectories to move to 2, maybe even to 1.5 degrees centigrade. we will not achieve this target if we are not driving towards collective actions. We have seen from the climate policy tracker assumptions that we are already far beyond 2.3, even higher degrees at the current trajectories when we just look at climate risk policies globally. So that means policies will provide the guidelines, but actions will need to happen. And again, this is an investment value chain. Hence, every actor in the chain following the guidelines has a role to play. But again, this is why I've also highlighted a bit earlier the importance of the harmonization of standard metrics, benchmarks, to move the shift from commitments and principles-based to actions and rules-based approaches, because the products of tomorrow that investors are investing in and are developing at scale are heavily dependent on the harmonization of these type of frameworks.
Thank you very much, Martina. We
Yeah.
have, I give you the floor in 1 second. We have
Sure.
two last questions. Now we have another question.
Yeah, I want to
on
respond to them.
I give you now the floor, Yuri, regarding the question from
Sure.
Ilaya, but actually also regarding the two following
Yes.
questions.
Sure. Yeah, thanks,
First
Martina.
is the first concern the deliverables of the project, and the second regarding the scope. Does it address? Is it addressed only to large companies or also to small businesses? Please, you.
Sure. Thank you. Thanks, Martina. Actually, yes, I think that your summary of the ongoing EU regulation and the needs of investors to be specific about how they measure and assess the company progress on the project as long as the funding they provide to the companies were targeted, labeled with social environmental objective. And this is in line with the John questions about drafting a model language for corporate governance documents. This is definitely something we have in mind. So thanks for your remark. We will keep it for the second part, the ongoing phase of development. So we really want to create a regulatory set of recommendation principle, and we really hope that we can provide, for instance, some guidelines to an accounting language to discuss the distribution and the allocation of funds to social and environmental projects, including reserve provisioning and etc. And we are still discussing the scope of our remarks. Of course, we started with the listed companies because also where the accounting regulation in EU start with. But I think in the spirit, our remarks will be broader, and we have to see how specific we can go with all the companies. But our project is not limited to larger companies. I think the general spirit can be applicable beyond them. I didn't read Alfredo's remark, but perhaps it's time to close. So I give back the floor to Corrado to conclude.
Thank you very much, Yuri. In fact, Alfredo's question concerned, I would say, more than the European legal framework, the international legal framework to promote the adoption of CO2 goals. And in fact, our project, if I may answer directly to this question, is mainly focused on what we can do at the European level, but it doesn't exclude, obviously, that it can also have a broader scope. But and I would like to thank all the panelists for their also the participants to the panel for their questions and for having taken part in this